Shares of AMC were down 36% in early trading Monday morning, but that doesn't quite tell the whole story about what's going on with the stock. Actually, investors have made money Monday morning, but this is a really complicated story, so let's get into exactly what happened today. Here's a look at the big changes today from AMC stock. The company issued AMC preferred equity, or what's being called APE shares. Now, AMC stock is down significantly from its close Friday at 1801, open this morning, down about 40%, and is currently trading at 1142, but APE shares are 747. Now, investors in AMC on Friday actually got one share of APE for every share of AMC they own. So in total, they're up almost 90 cents for the day. So not a bad day from a trading perspective. The question you might be asking is, what exactly are these APE shares? And that's where the story gets more complicated. AMC is issuing these preferred equity shares to shareholders as of Friday's close. So every shareholder will get shares on a one-to-one basis. And there's nothing shareholders need to do to get these shares. They should just end up in their brokerage account. It's notable that this is being called a dividend, but it's not a cash dividend, which is what investors are used to. This is actually a stock dividend. So they're basically giving you a share of stock for simply owning stock. As a result, prices adjust accordingly. Can AMC just go ahead and issue new stock just for the sake of issuing stock? Well, the answer is yes. And investors actually approved a preferred equity plan back in 2013. That's what the board of directors is taking advantage of. I'll note that this is really happening because AMC agreed in 2021 as part of a share issuance plan not to issue any more stock. So now they can go to investors and say, hey, we're not actually issuing shares of AMC stock. We're issuing shares of AMC preferred equity, which is a completely different stock. But AMC preferred equity is not a preferred equity that's paying a cash dividend. It's exactly like a common stock. And so it's going to be issued in the same way a common stock is as well. You can look at this as a 2-for-1 stock split, which I will get to in just a second. I want to thank this video sponsor, The Motley Fool. Visit fool.com/Rive right here to receive the top 10 best stock picks for you to buy right now. That's fool.com/Rive. All right, now this is what management is saying about this stock dividend. You can see right on the bottom here, this part I have highlighted, similar to a 2-for-1 stock split. So these are going to be different stocks, but they're effectively going to be exactly the same. They have the same economic value. They have the same voting value. So from a trading standpoint, they should be valued at a very similar level. But here's where things get concerning for AMC investors. What management really could do is dilute shareholders who currently hold the stock. And that was the idea of having this provision where they couldn't issue new shares in 2021. As a result of this issuance, there are going to be 516.8 million shares of APE out there in the world. But management could issue up to 1 billion shares through the end of 2023. Going beyond that, they have the authorization to issue up to 5 billion shares of stock. So we could see the AMC stock that we know today be about 500 million shares, and this APE stock be about 5 billion shares, and those shares would be exactly equivalent. So that would be about a 10x in the shares outstanding. That's what's possible with this issuance today. So what happened in short? Effectively, there was a 2-for-1 stock split. 1 share of AMC stock became 1 share of AMC and 1 share of APE. This also gives management the ability to issue another 483 million APE shares to raise money through the end of 2023 and up to 5 billion shares long term. This could potentially be very dilutive. The other thing to note today to complicate matters is that Cineworld, which is the number 2 theater operator in the world, is considering filing bankruptcy. So from an operational standpoint, these companies are on very weak footing. Why does management want to raise money? It's because they need money just to keep operations going. So what does this mean for shareholders? For one, we should understand that these 2 shares are exactly the same from an economic and voting standpoint. They should be priced similarly. So if you're interested in holding this stock long term, APE shares are actually the way to go. The reason that AMC shares are staying as high as they are today, I think, are really down to the market dynamics. There's probably a lot of short interest that has to come out of the market to really adjust. But long term, we should see shares actually kind of equalize between the two of them. It actually wouldn't be a bad idea to move from AMC's shares to APE shares if that's what you own. Now, I don't really like the theater business long term, but this is one of those cases where the headline story is maybe a little bit different than what's actually going on underneath. If I were an AMC shareholder, what I would be worried about is management issuing a ton of stock just to keep the company afloat. These operations are not doing particularly well. That's what really needs to improve long term. I have my own questions about whether the theater business can be a profitable business, but this share issuance today is not what's ultimately going to crush the company. It's just kind of a strange market dynamic, and not understanding what's going on the under the hood is really important.